What's going on, guys? Welcome to episode 7 of Property is a Game of Finance. Today we're joined by Ben from Bayswater Financial. He's a financial planner. How you going, man?
I'm good, Jack. Thanks for having me on today.
No worries. Thanks for coming on. We've been working together for, I don't know, when did you come to the office that time?
I've been working with you for about a year and a half now directly.
Yeah.
I've been working with your company for probably 4 years.
Yeah. So you were first introduced, well, I knew about you before you came into the office because we had a process where we were sending out emails to clients once they've hit formal approval, asking them to reach out to you and get financial, get insurances and stuff because they've got more debt. But I never really pushed it until you actually came in the office and had a chat to us about how serious it is.
Yeah, that's right. I mean, I originally came to a lot of the business that we get off mortgage brokers is purely on the back of recommending appropriate insurances to their clients because they've taken out new debt. A lot of people don't really understand what types of insurances are on offer and why they're important and also what they cost and whatnot. Getting in front of people like yourself and explaining it to you in person is pretty much the only way to really get it through to people. And yeah, since I've done that, you've been referring a lot of business to me, which is great.
Yeah. And then I've got you to do the podcast now, so thanks for that.
It's my first one, by the way, and I'm enjoying it so
You're doing
far.
well, man. You're doing well. Stay calm. So you're a part owner of Bayswater Financial, right?
Yeah, that's right. So Bayswater Financial is a financial planning company. We've been around for about 5 years now. Me and two friends got together and we started our own company. We've all worked in the financial services industry for probably over 10 years each. It's me, myself, Christopher Hall and Beta Strick. Our office is down at Rose Bay, which is a nice part of town. And we're on the road a fair bit and on Zoom a fair bit as well these days doing business.
Yeah. So how many aspects of the business are there in the financial planning business?
That's a good question.
Because you specialize in insurance.
Yeah, so we tend to focus on insurance advice, which is personal advice these days. We're also licensed to give advice around superannuation, retirement planning, and strategic financial planning. So, investment advice, asset advice, budgeting and cash flow management. But as I was telling one of your colleagues before the podcast started, most people come to an advisor with a specific issue or something specific they want to sort out. And we tend to focus on that and give them advice around that area.
Yeah. Yeah. So, I mean, insurance is I've said it on previous podcasts before, insurance is one of the biggest risk mitigations when someone's buying property, investing in property. Cash flow, I mean, a cash buffer is another one. I mean, because if you can't work or something happens when you lose your income and you've got all these loans that you're supposed to pay off and you don't have insurance, you're kind of screwed, right?
Okay, so we're going to talk about the importance of having insurance.
Let's do that.
So it's a good thing. So most people, when they buy an investment property or buy their home, take out debt to do that. Most people don't turn up to an auction and go, here's $1 million cash, or buy the house for $1 million. They go to a bank, a lender, someone like you, Jack, and they borrow the money. Now, if something was to happen to them after they took out the debt and they were to pass away, if they had dependents, like a partner who was dependent or children or anyone who's financially dependent on them, who's there to service the debt now? No one. So the life insurance policy can, cover the debt. So there's no debts or obligations left for the dependents. And it can also leave a cash buffer, which can help finance the children until they reach 18 or 21 or however old they need to be financially independent. So life insurance does make sense for a lot of people. Again, there's no point having life insurance if you've got no dependents and you've got no obligations. I get that. But if you're taking out a loan, buying an investment property and you've got kids and whatnot, seeking advice around life insurance is something I'd strongly recommend to anyone. But there's also other insurances. It's not just life insurance. People think it's life insurance and that's it. No, there's other policies such as tail and permanent disability cover, income protection and trauma. The income, I won't talk too much about TPD and trauma now because it's a fair bit in it, but income protection is something where most people who live in Sydney, who work, their cost of living's gone through the roof. The food, petrol, and also the mortgage costs have gone up. If they were to become injured and they couldn't work, yeah, there's a bit of sick pay and holiday pay, but for most people, it might run out after 30 or 60 days. Then after that, who's going to pay the bills. And an income protection policy is something which we recommend to a lot of people. It helps cover the cost of living until a doctor says, you're right to go back to work. And it can be on the grounds of, physical and mental reasons why they can't work. And unfortunately, bad things happen to good people, and having insurances in place just means that they're covered if it does happen to them.
Yeah. I mean, life insurance is probably the only one I wouldn't get because you're dead anyways. It doesn't really matter, right? No, just joking. I have a kid on the way. I think that will change.
It'll change very, very quickly, and also your life is going to change very, very quickly, Jack.
Yeah, look forward to it. No, I just got approved for a unit upstairs, so my to and from work distance is like a minute.
Yeah, nice one. Nice one.
Let's talk about the application process of getting insurance, because you not everyone is guaranteed to qualify for insurance, right?
Yeah, so there's two types of policies with insurances. There's grouped or pooled policies, which is usually the default cover which people have through most of their industry super funds. So Australian Super or Hester or whatnot. If you don't change your insurance within them and you just take it out, they'll give you a default level of cover. Now, they're known as pooled policies, where they don't underwrite you. They don't call you up and go, look, before we give you this default cover, we want to ask about your height, your weight, and your health record or anything like that.
So did you say that's what you have within Super?
Yeah, you can, and it's common to have default cover with your industry super fund. Mm-hmm. It's something that they give to you automatically, where unless you opt out of it, and most people have it. Now, that level of cover, as you know, Jack, as I've talked in the past, is usually inadequate if you've taken out $1 million loan in Sydney, because it's usually a couple of $100,000 and it's not underwritten, and there's could be exclusions for mental health and other things. So that's what most people have as a default cover. The policies which a financial advisor recommends is known as an underwritten or a standalone policy, whereby they enter into a contract with an insurance company, and they do the underwriting at the time of application. So if they go to make a claim later on, the underwriting's already been done on it. It's not people have got a big conception about insurance companies where they think that they're just going to get cover straight away when they apply. The insurance company will ask you about your health. So one of the issues that we see as an advisor is we get a lot of older people who call us up and say, oh, Ben, I want to take out life insurance. Yeah, cool. And I say, okay, how old are you? I'm 55. Okay. Oh, the cost is going to be a couple of $1,000. Oh, no problems. The reason why they're saying that is because they've had health issues in the past. They've had friends who've passed away from it or whatever. And when they go to get underwritten, they might actually got a higher chance of getting knocked back as you get older than if you take out insurances when you're younger. Now, the reason for that is when you get older, you get a bit of wear and tear. You might have a health history of diabetes or have had cancer in the past or whatnot, and they may get knocked back by the insurance company. So they won't take any money. They'll do an assessment and an application where they'll go through your health history, and then they may knock you back. With the younger people, it's a lot harder for us as advisors to try and get them on board, because when you're young, you think you're bulletproof, you've got no health issues. Why would I take out insurances? None of my friends have died. They don't realise it's taking out insurances when had nothing wrong with you health-wise. You're going to have no exclusions or anything like that, which means that your policy is as good as it can be. And also the premiums aren't that expensive because you're young and the probability of you dying is lower or getting injured is lower, and it increases with age. So as far as the application process goes, is you basically you're engaging into a contract with an insurance company, and before that contract's signed by both parties and in force, they do a health questionnaire, and then they can come back with, an acceptance or a decline or amended terms or whatnot. Yeah. So it can take a period of time. We've got applications which can take 6 to 12 months to get over the line because of outstanding health inquiries from, specialists or, follow-up appointments which haven't been done. Other applications with young people with no health issues, it could be sunk in about a week or two. So the time frame depends on the person and their health condition and what cover they're applying for and their age and whatnot. So usually young people, no health issues, a couple of weeks. Older people who have had health issues, who've got medical conditions, can take 3 to 6 months. Yeah. But in having said that, there's a reason why it takes 3 to 6 months. That's done properly and fairly, and that if they ever go to make a claim, there's no skeletons in the closet which can knock back the claim.
Yeah. So the default cover that they have in their super,
Yeah,
that comes at a cost as well, right?
Yeah, so they're known as pooled policies, and they tend to pool smokers and non-smokers together. Generally speaking, life and TPD is probably 20 to 30% more expensive as default cover through super than standalone cover.
So if they come and see you, they could pay less.
They could, but
And
most
get more
likely they will for life and TPD.
Yeah.
And the premiums will be cheaper through
Yeah.
standalone policies. And it's not just me; it's any advisor they do it who does it through, best interest duty and getting quotes and prices from different insurance companies. Just on that point, I'll say if one of your clients or anyone out there engages an advisor, the insurance advice is viewed as personal advice, which means we've got to take into account their personal circumstances and we've got to act in their best interest, which means that we do go to different providers, like a bit like you do, Jack, with home loans, and we see what different pricing they offer, whether it's TAL, AIA or Clearview or any of those other big providers, and the different terms and conditions. And then we say, based on the client's circumstances, this is the best provider for the client. And usually it's a lot cheaper than what they're paying for with their life and TPD through super.
Yeah.
It's significantly cheaper. Income protection is different. The reason being is because there's a lot of different terms with income protection compared to life and TPD. Things like waiting periods, benefit periods, and sum insured. So quite often when they've got default cover through super, the benefit period may only be 5 years or 2 years as opposed to a 65-year benefit period through that will offer. And that's the case because most of the time people work till they're 65 and they need to protect their income till they're 65. That's going to be a more expensive policy than a 2-year benefit period, generally speaking.
And that was one of the game changers for me when, I knew about you. I saw your card in the reception. I saw you in the email trails, but I never really understood it until you come out to the office and explained all this to me. And as soon as that happened, I was, talking to my clients actively about it, especially, some people are trying to push themselves a lot in, trying to buy properties, trying to get as much debt as they can. And they don't realize that sometimes shit can go bad. And just to have someone like you and it's really simple as well. Like what you said, you could save the money and get them better cover. And they don't even have the adequate cover to cover what they have.
Yeah, and the way I explain it is, look, hopefully you never claim on it. Hopefully it's just a couple of $1,000 a year that you pay that you never claim on. But if something does happen, like you do have a heart attack or a stroke, you can't work for a couple of years. It's a big difference having 10 grand a month coming in or 5 grand a month coming in through an income protection policy as opposed to nothing. That changes your life. That means the wheels don't fall off the bus. You can still pay the mortgage. You can still put food on the table. It's the same thing with having life insurance. Might cost you a couple $100 a year, a couple $1,000 a year if you're older, but if you were to pass away, that $1 million going to a beneficiary changes their life as opposed to not having it. So it's well and truly worth it. Like I said, you're not going to get recommended policies through an advisor unless it's in your best interest to take them out.
Yeah.
Whether you take them out or not, it's up to you at the end of the day, but what gets recommended to them through any advisor in the country now is in their best interest to take out.
So what about income protection? Like, how does that work? Because if, say, someone's 30 years old and they've got 3 investment properties and they get injured at work, how does that work? Do they come back to you or do they go directly to the insurance company?
Okay, yeah, good question. So it's the income protection policy. It doesn't matter what they've got, how many properties they've got. It's just basically if a doctor says that you can't perform your job, whether it's because of a physical condition or a mental condition, you can't go to work.
Yep.
Once the wait period's been hit, you will get paid out that monthly payment. That monthly payment will continue until a doctor says, you're right to go back to work, or you hit the benefit period, whether it's 5 years or to 65 years of age.
Yeah.
On your point about, an example, and, this is just general advice, I'm not giving personal advice on a specific example, but someone's got a couple of investment properties. Yeah. We're heavily compliant, and it just continues to be more compliant. But, one of your clients, for example, someone who's got their own home in Sydney, they've got a bit of debt on that, and they've got an investment property, 1 or 2 investment properties and a couple of young kids. The investment property might be neutrally geared on the assumption that the person's paying tax and is earning an income. The moment they're not paying tax and not earning an income, there's no negative gearing because they're not losing the money in
Yeah.
tax. So all of a sudden, that neutrally geared investment property becomes a burn in the back pocket, but there's no money coming in because the person's injured. So it's a double whammy to what normally occurs. So definitely income protection for someone in that scenario is something that we'd recommend.
Yeah. And I mean, there is still opportunity for someone to get a loan if they've got income protection, as long as it's on the way, all the way to retirement. I've had clients come to me in the past where they're on a policy all the way up until retirement.
Yeah.
There's a lender that'll give them a loan, like if they need a refinance or even if they want to purchase. So just because they've stopped working and they think their life's over, they're not going to invest anymore. If they've got the right cover, they can keep going or hold on to it for long enough to where they can sell, because at the time that they get injured or something might not be the right time. Could be a bad time for them to sell. But yeah, that's good, man. What do we got here? Yeah, so I want to talk about the Royal Commission and how that affected you and affected mortgage brokers as well.
Yep.
So were you in the game before the Royal Commission?
I started financial planning in 2014. So the Royal Commission was just kicking off a year or two after that. It was a long process, the Royal Commission. There was a lot of good things that came out of it in regards to reshaping the industry. But there was a lot.
How so? Like, what was it like before it and then after it? What were the changes that were made?
Well, a lot. That's the first thing. Yeah, there was a lot of changes. You talk about legislation and whatnot. It got rid of a lot of the conflicted remuneration and a lot of the advice which wasn't in the client's best interest to take out. After the Royal Commission, the whole concept of best interest duty was a big thing, to act in the client's best interest for all advice and looking at them holistically. And I think the industry's been better for that. Yeah.
Yeah. So I actually got into broking around exactly when I started hearing Royal Commission.
Yeah.
And I was like early 20s, man. I had no idea what was
Yeah.
going on. And the broker that was getting me into it was telling me like, oh, like all this shit. Like they had no idea what was going on. Like looking back at it now, I don't think it was, I'm sure like he's still in the game. We're all good still. We figured it out. But at the time it was happening, it was probably the worst time for me to get into it. Like,
look, I think further to what I said before, from a business owner's perspective, whenever you've got Royal Commissions or regulatory changes going on in the industry, it's a lot of uncertainty that surrounds your business, and you don't know if it's worthwhile staying in the industry, because there's a lot of stuff that's up in the air. There's a lot of stuff that's been proposed by politicians. There was an election recently, as everyone knows, and the Liberal Party got kicked out and the Labor Party got voted in. Now, their policies were different to the Liberal Party's policies 3 years ago. However, recently they've changed to be similar. So there's a lot of stress that comes with all that, not knowing what's going to happen if a new political party gets in, not knowing how it's going to affect your business. And one of the downsides, in my view, to all the Royal Commission, everything is just the level of compliance and admin and the cost burden to a financial advisor. People don't understand how much compliance goes in behind the scenes when we do recommend something as simple as insurance advice, purely just to meet the regulators and our obligations requirements. And I'm assuming it's the same with you, with your responsible lending criteria.
We're doing 1,000 words per application.
Yeah, and it's in my view, that's overkill.
Oh, you reckon?
It's overkill. It consumes time and resources, and it doesn't put the client in a better position. I don't believe that, but I'm not the boss. I just get told what to do, and we just follow what the guidelines are.
Yeah. You touched on before about the cost of living increasing, and that's coinciding with interest rates.
Yeah.
Why are interest rates rising now?
Okay, so I think what we're going to talk about now is what
they're
people are talking
normalising.
about. It's sitting at home at the dinner table at night time. So the first thing the point that stands out for me is I think the cost of living rising is more burdening on the family budget than the rising interest rates. For example, I've got a couple of young kids, I've got a mortgage, and I've got to put food on the table. I notice it more in the weekly shop, the increase, and just the cost of living for goods and services than I do with my mortgage rate going
Yeah.
up. And I'm on a variable, so
Yeah.
it's gone up like everyone else's. So how they get the cost of living down is more important than how they control interest rates, as far as I'm concerned. My view on how they get the cost of living down is you've got to increase the supply of energy and you've got to increase the supply of food. Two things which Australia's got pretty much an unlimited amount of. So I can't see why our cost of living for those two things are going through the roof, and it flows onto everything else. So that's the one thing. They've got to control that. That's
nuclear energy, mate.
Yeah, well, it's just getting more supply of everything. And we've got supply of everything. We've got supply of fossil fuels. We've got supply of the sun shines in Australia quite a bit. So if you want to go down that path, go down that path. I'm not saying which way to go down, but I'm saying we've got a lot of everything. Yeah. So I don't understand why we're paying so much for everything. Food wise as well, we should be the food bowl of the whole of Southeast Asia. So I don't understand why food prices are going through the roof. Interest rates, why are they raising interest rates now?
Well, they're the same as what they were 2019 pre-COVID. So it's normalizing, right?
Yeah. Look, interest rates are a part of monetary policy, and the government, central banks around the world are going, okay, well, we've got rising inflation. How do you fight rising inflation? You raise interest rates. It's the only tool they've got, apart from reining in spending, which is fiscal policy, which they're not going to do. So they're going to raise rates. Now, we've got higher inflation. Central banks think if I raise the interest rates, that'll bring down inflation, problem solved. Now, I don't think that's the case because as we talked about, the rising cost of living and the inflation side of things, it's all supply issues. So unless they fix the supply side of things, I don't think it's going to get down the cost of living by raising rates. It's going to push down hard assets, which is what we've seen, such as property and share market. That's what we've seen over the last sort of 6 months. It'll continue to do so. My thoughts on where interest rates are going is the same as anyone's thoughts. I don't know. No one's got a crystal ball, but I do think we're going to see the path of them raising rates a few more times. And then I think we're going to see some stage in the middle of next year them throwing in the towel and realising that the Australian economy can't deal with higher interest rates because of the amount of debt that's been taken on at a national, state and household level. And then I actually think they're going to start cutting rates at the end of next year sometime, quite aggressive, because they realise that we can't afford the higher rates.
Yeah.
That's my thoughts, and my thoughts are as good as anyone's on that, but that's what I think is going to happen.
Yeah. All right. Well, before I end it, I want to say you've taught me something where anytime I'd send you a client, no matter how long it took you to get them on, you would always call me up and say, yeah, send them over, mate, keep sending them over. And I've started to do that with agents, and it actually works, man. Like if you just ask, you just keep asking, send them over. It's so funny, man, the way you do it. And it's been good working with you, man. I appreciate it.
Yeah, it's good. We've sorted out a few of your clients, and they've been happy with it, and hopefully we can keep working in the future. But I think as a mortgage broker, a young mortgage broker, he's been in the game a couple of years. I think you've got a big future. Even if rates do rise, there's always going to be a market there for people needing to refinance or take out a home loan. The investment side of things will probably dry up or slow down for a period of time. These things go in cycles. And people more often than not need their insurance reviewed. If we can't help them out, we just tell them we can't help them out.
But it gives me peace of mind too. Yeah, like it's some people are very aggressive with how quickly they want to buy, and sending them to you, giving them that insurance gives me insurance. Like like that's good, because if shit goes wrong and they're looking for someone to blame. It's going to be someone. So if they've got insurance and they're all good, then that's
100%.
Yeah. All right. Well, thanks for coming on, man. I look forward to getting you on again.
Yeah, no worries, Mr. Rassam. I will be back, and hopefully we can talk about more subject matter moving forward.
All right. So anyone watching at home, all the show notes will be in the description for Ben, and like, subscribe, all YouTube, Facebook, Instagram. Thanks for watching.